Anyone's heard of the term green shoots? Ben Bernanke, the chairman of the Federal Reserve in the US, the equivalent of Dr. Bollard here, said, he's seeing some tentative signs of recovery or indicators starting to point up. And there's many of them that sort of turned the corner, and one of them is the number of job losses in the US. So this is the payroll numbers out of the US saying as a change. So we troughed out at just over 700,000 jobs a month being lost in the US. 700,000 a month. We're now losing in in May, the last number, 345,000 jobs in the month. And he's saying, this is sort of tentative signs of recovery. So many of these green shoots is the idea that we're going down at a slower rate. Okay, I don't think that's recovery. It's certainly good that we're not going down at a faster rate, but it's really early days in saying that the world is back on its feet. Sure, there is some tentative signs that the rate of deceleration is slowing, but it's a far cry, I think, to say that we're actually getting genuine recovery. By the way, the US economy has lost 6 million jobs since the start of last year. Pretty nasty stuff. The unemployment rate over there, 9.4. Unemployment rate here, 5%. So we're certainly doing better than some in the Northern Hemisphere, especially the US and the UK. So what is the global growth recovery going to look like? We're going for the shopping trolley. Where are we now? I think we're on the first lift. If the horizontal line is the zero line in terms of whether if you're above it, you're going forward, if you're below it, you're going backwards. I think that's sort of the job numbers. We're going backwards at a slower rate of knots at the moment. I think markets, the big boost in equity markets and the lift in the New Zealand dollar is projecting this line that we've seen, the bounce in jobs, to continue upwards from here. We're not so confident that we're out of the woods in terms of the real economy yet. We think realisation that these green shoots they're not really signs of recovery, that we're still losing jobs and the spending is still going to be pretty soft. So we're going to get a bit of a realisation in our view in the next sort of 6 months that these green shoots aren't really recovery, it's just going down at a slower rate. We have a bit of a pause before we actually see genuine recovery 2010. We got sick of making up letters in terms of U's and V's and L-shaped recovery, so we've gone for the shopping trolley. We'll see how we go. Why do we care? Why do we care about world growth? Obviously, as an agricultural industry, we sell a whole lot of product to the world markets. And the primary sort of transmission mechanism, if you like, from world economic growth, which is the black line here, going down 2% in 2009, at least on forecast, commodity prices tend to follow world growth very closely. If the world is growing, incomes are growing, demand is growing, prices tend to go up. Vice versa when the world contracts. When you look staring down the barrel of a -2 for 2009, commodity prices, it feels in aggregate, have a lot further to fall. We're nowhere near that pessimistic. We think the supply side is having a huge impact on some of our products, especially in the lamb side of things. To think the lamb prices where they are now, usual seasonal low and they're at record highs, shows you that the supply side has moved so far, given the international conditions are so weak at the moment and we still have very high prices. Venison would be another one. Obviously dairy prices, the other side of that, with the supply side only just starting to respond, and certainly the US dairy subsidies and EU subsidies not going to help that in the slightest. But in general, we don't think commodity prices have much further to fall, if any, and we're looking forward to recovery 2010 once demand starts picking up and that supply situation remains pretty tight for many of our markets. Certainly the key mechanism for transmitting weak world activity to the New Zealand economy. I'd rather be making food than anything else. This is a chart that shows exports across countries, so various countries' exports compared to a year ago. New Zealand, in the 5 months through to May, numbers just released the other day, we actually exported in value terms more than we did in the 5 months to May 2008. Australia did exceptionally better than that, with much stronger growth helped by their minerals and exports to China. but if you look across many of the other countries that we usually compare ourselves to, say look at Japan, the second biggest economy in the world, and their exports have effectively halved. If you're making cars or high-end electronic consumer goods, that's the stuff that consumers tend to stop spending on first. And it's interesting to see hear Jacqueline say about the organic market. Sort of the luxury items or the high-end goods, whether it be high-end food and or high-end consumer goods, certainly get hardest when incomes go backwards. So it's certainly, from a relative perspective, it doesn't feel like we're doing very well, but relative to many others around the world, we're doing pretty good. Doesn't make it good, but relatively good. Okay, so the world's pretty ugly. What's the market been doing? How has the markets responded to what has been pretty volatile times, to say the least? Back to the World Commodity Price Index, the red line, as it tends to track world growth. One of the key things for New Zealand is the New Zealand dollar. And so, okay, whatever world prices are doing, the currency influences hugely what we actually get at the farm gate. When world prices are very strong, you tend to see the New Zealand dollar bid up. If world prices are high, it means exports are going to go up. It means the New Zealand economy is going to go well. It means that you buy the New Zealand dollar because the economy is going to go well. Vice versa when product prices fall. And so when you had commodity prices, or say powder prices, up at $5,000 a tonne US, and they fell to $2,000 a tonne US, the Kiwi currency quickly went from 80 to 50. Now, I guess in the last sort of 18 months, when the credit crisis has been underway, there's been a gap opened up between where product prices were and where the Kiwi currency was. So in the last 18 months, you can sort of see the red line a lot higher than the black line being the currency. That really is a measure of risk, so that even though product prices were quite elevated, the Kiwi dollar didn't go as high as you might have thought, given where product prices was or were. Likewise, when the Kiwi dollar got down to 50 cents American, that was actually relatively cheap compared to where the product prices were trading and still are trading. So the bounce from 50 to 66 and now back to about 64.5, we would sort of rationalise as it's actually a return to where product prices on average are. That doesn't help if your particular product price doesn't go up, and I'm thinking dairy in particular there. It certainly puts a huge pressure on the exports of that product. Where to from here? There's another absolutely no idea. I reckon the range is somewhere between 40 and 80. And even then, I don't think I've got absolute confidence in getting it right. I say that partly as a joke, but it's partly true, right? It is extremely hard to know. Even if the world recovers and commodity prices start going up in mid-2010, which is our core view, the Kiwi dollar we do think can get back through 70 towards the end of next year and into 2011. The converse is the fact we have massive overseas debt. We haven't run a current account surplus since 1972. So when you look back to 1986 and you see the fluctuations in the dollar very closely linked to commodity prices, the whole level of the thing could well be too high, and it feels too high. And it's easy to say as an economist and say the currency's too high, it should be lower. It's like it's freely floating, so people trade it wherever they want to. The buyers want it cheaper and the sellers want it dearer, just like any other product, whether it be land, the dollar, or powder. It certainly isn't going to do us any favours where it is now in terms of the export recovery that we need. So where to next? Our view is it does go back into the 50s against the US before getting back above 70 in maybe 18 months' time. The reason going back into the 50s, we think this realisation globally that these green shoots aren't really what they're being made out to be, that will see risk being sold a little bit. We'll see the New Zealand dollar come back a little bit. Certainly plenty of things moving. The US dollar in its own right is under a lot of pressure from a lot of printing of money and the like. So all bets really are off. But for now, central view is that it goes down before it goes up. I think that covers bases, doesn't it? Okay. One of the real big implications of that relationship that the dollar tends to follow where product prices